Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. The weakening of the Aussie dollar is both likely and necessary. That's the message to come out of the RBA's bulletin and meeting minutes. But what does the path of the currency mean for the central bank as it continues to attempt to put the Australian economy back on a path to growth? I spoke to Milch at Suncorp Group. Milch, thank you so much for taking the time to chat with Dukascopy TV once again. Always a pleasure to see you.
Thanks, Natalie.
Okay, so we're talking RBA today, really very interesting of late. The latest RBA bulletin has labelled financial conditions as accommodative, yet in a recent speech, Governor Glenn Stevens did suggest that monetary policy in Australia had sort of reached a limit almost. So which is it?
It's both, is the short answer. Certainly monetary policy is accommodative, so the level of rates is very low, 2% cash rate. That means for most people their borrowing costs are very low and not really a limit to economic activity. You and I can buy a house, businesses can invest with very low borrowing costs. What Glenn Stevens is referring to is the fact that those rates are so low that lowering them any further won't really make a difference. So if the economy is not moving, it's due to things other than borrowing costs, things like confidence and so forth. And we think that's very much the case, that rates are now at a level that it doesn't matter anymore and there are other things going on in the economy stopping growth.
The latest bulletin also suggested that despite these rate cuts, businesses really aren't taking the opportunity to invest. Why is that? And is this, again, as the Governor suggests, the reason why Australian growth isn't picking up?
Yeah, so if we go back to that theme we were just talking about, rates are so low, so what is it that's stopping growth? And there's a few things. Yes, the Reserve Bank has recently released research and they've spoken about it. One is hurdle rates on investment. So when businesses sit down and do their evaluation of business projects, have they lowered the hurdle rate that project has to earn in order to invest? So borrowing costs have come down. It would make sense that businesses should also lower that hurdle rate. It appears that they haven't, or not to the same degree. So the RBA research shows that hurdle rates are still stuck up around 10%. That's clearly a factor. There are other factors at work though as well, and the RBA have spoken about this. Things like risk aversion, just a willingness around board tables to take a bit more of a risk on growth. There are other things as well. This trend in the share market today to give excess cash back to shareholders. That tends to be self-reinforcing because shareholders are rewarding that return of cash via dividends or capital returns rather than rewarding companies that keep it within the business to invest for growth for the future. So there are a few things going on here, a lack of confidence. So all of these things are adding up to kind of override the fact that rates are so low and they're stymieing that investment.
Is there more that the government could be doing? For example, at the RBA's May meeting, it was really outlined very clearly that really what the central bank needed was a supportive federal budget. Is the fact that businesses aren't going to those extra lengths to invest a suggestion that perhaps the budget didn't really go as far as it perhaps needed to?
Okay. Let's talk about the budget and the impact of the budget. I think one of the big problems we've had in the economy is the previous budget, the 2014 budget, was received very, very poorly by businesses, by consumers, and that really damaged confidence. The 2015 budget, it's probably a little too early to tell. We're only a month down the track. I think it would only be fair to judge the success or otherwise of that budget in about 6 months' time. But what has the RBA said about the budget? I think they've said that this one is better than the last one. It's better because it didn't attempt to cut spending too much at a time when the economy is weak. It introduced some incentives to invest, and again we'll have to wait a few months to see whether that's worked. The one area of frustration, I think, from the RBA, and they've spoken about this recently, Glenn Stevens in particular, is around infrastructure. I think they want to see more infrastructure. Now, infrastructure won't get the economy going today. It takes a long time to get infrastructure working. But what it will do, it can generate confidence, it can generate a degree of optimism that there is a plan and there will be work in the pipeline and there are attempts to improve the nation's productivity. Those things can be beneficial today, even if the actual work is a long-term theme. So I think the RBA would have liked to have seen more on infrastructure, but the budget itself wasn't at least as negative as it was a year ago.
Certainly something else the RBA would be looking to see is a weaker Aussie dollar, which frankly we're just not. Even in early trade on this Friday, we saw it creeping to that US 78 cents level. How does your outlook for the currency sort of therefore impact your outlook for RBA positioning really into that mid to long term future?
Okay. The consensus, let's talk about the consensus, because the consensus is very much along the view that the currency is going to weaken. It's around the idea that the Fed's going to tighten later in the year. That'll lead to a stronger US dollar and a weaker Aussie dollar. So we're at 78 cents, give or take a little bit today, and the consensus is for 72 cents a year from now. I'm not so sure. I'm in a slightly different camp. I think the Aussie dollar could in fact climb, maybe back over 80 cents in the next few months. And why I say that is because I think we probably have hit bottom. And we're now on a little bit of an upswing, both globally and locally. Globally, I think China's probably stabilising. Commodity prices have lifted a little bit. We're seeing some signs of improvement locally. Business confidence has lifted a little bit. We know the housing sector is strong. Rates have come down. The Aussie dollar has come down. All of those factors, I think, will help the economy over the next 12 months. So if the Australian economy improves, I think so can the Aussie dollar, even against a slightly stronger US dollar. So it's not as positive for exporters, and exporters are doing well today out of the weaker Aussie, but it's important to remember that stronger dollar, if it does occur, that stronger Aussie dollar, if it does occur, is in an improved environment. So there isn't such a need for the stimulus that we have today.
Stephen, always great to receive your insights. We look forward to seeing you again in the near future. Thank you.
Thank you.
Sadly, that is all we've got time for right now, but do stay tuned to Dukascopy TV as the TV team will continue to bring you all of the very latest in FX updates and analysis. From me, it's goodbye for now.